program is The Active Center. It's created by David Sappe.
Pronounced Seppi.
Pronounced Seppi.
All right, let's talk about investing. If you've ever felt like you should be doing it, but have no idea where to even begin, then this is for you. We're going to break down one of the most powerful and, honestly, simplest tools out there, the S&P 500 Index Fund. Let's dive in. So does the whole idea of investing just feel like a trip to the casino? For most people, yeah, absolutely. Trying to find that one stock that's going to take off, it feels like you're searching for a needle in a haystack. It's complicated, it's stressful, and let's be real, it's totally overwhelming. If you feel that way, you're definitely not alone. But what if I told you there's a way to invest that completely sidesteps that high-stakes guessing game? An approach where you don't have to be a stock-picking genius to succeed. Well, believe it or not, there is, and that's exactly what we're about to unpack. So what on earth is an S&P 500 index fund? Okay, put simply, it's one single investment that buys you a tiny little piece of the 500 biggest and most important companies in America. We're talking Apple, Microsoft, Amazon, the whole shebang. You're not just buying one company, you're buying a slice of the entire top layer of the US economy. And just to give you an idea of the scale we're talking about, it's huge. Those 500 companies, they represent about 80% of the total value of the entire US stock market. So when you buy into an S&P 500 fund, you are getting a massive representative piece of the action. Here's the best analogy I've ever heard for it. Imagine a horse race. Instead of trying to pick the one horse you think is going to win, you just bet on the entire field of top horses. You're betting that on average, the group as a whole is going to move forward. It's a huge mental shift from picking to just participating. Okay, so it sounds pretty good, right? But let's be real, no investment is perfect. And to make a smart call, you have to look at both sides of the coin. So let's get into the reality check, the pros and the cons. The biggest advantage, hands down, is diversification. If one of those 500 companies has a truly awful year, well, it's cushioned by the other 499. That's a huge safety net. But the flip side is, you're tied to the market. If there's a recession and the whole US market tanks, your fund is going down right along with it. So you're diversified, but you're not invincible. Now, let's talk cost and performance. These funds are what we call passively managed, which is just a fancy way of saying a computer is running the show, not some high-paid manager. And because of that, the fees are incredibly, incredibly low. But here's the trade-off. The fund is designed to match the market's performance, not beat it. You're giving up that lottery ticket chance of a massive win for the steady consistency of just getting the average. And a few other quick things to think about. On the plus side, it's so simple. It's a true set-it-and-forget-it kind of deal. On the downside, remember, this is only US companies, so you're not getting any exposure to the rest of the world. And lastly, there's something called market cap risk. Basically, it just means the biggest companies, like Apple and Microsoft, have more weight. So if they have a bad day, it can pull the whole fund down a bit more noticeably. Okay, enough with the theory. You get the concept, you've weighed the pros and cons. So the big question is, how do you actually do it? How do you get started? Let's get practical. And here is probably the best news of all. The barrier to entry here is practically zero. You know, some old school mutual funds might require $1,000 to get started, but many of the modern versions, called ETFs, have no minimum at all. Seriously, you can often start with just enough money to buy a single share. Just look at a few of these real-world examples. That ticker is just its stock market nickname. But look at that column on the right, the expense ratio. That's the tiny annual fee. Now look at that top one from Fidelity, FNILX. The expense ratio is zero. Zero. They literally charge you nothing. The others are just a few hundreds of a percent. We're talking about pocket change. So once you've picked a fund, how do you go about investing in it? Well, there is a brilliant, super simple strategy that goes perfectly with this, and it's all about taking your own worst enemy out of the equation, your emotions. It's a concept called dollar cost averaging, or DCA for short. It sounds complicated, but the idea is dead simple. You invest the same amount of money on the same schedule, like say $100 on the first of every month, no matter what. Whether the market is soaring or crashing, you just keep going. So here's how it plays out. You pick your amount, you pick your schedule, and then you automate it so you don't even have to think about it. Now, when the market is down and stocks are on sale, your $100 buys more shares. When the market is up and things are expensive, that same $100 buys fewer shares. Over time, this automatically lowers your average cost. It's investing on autopilot, and it's brilliant. So we've covered what this thing is, the good and the bad, how to buy one, and a smart way to do it. But the single most important ingredient for success here isn't a ticker symbol or a strategy. It's something else entirely. Check this out. 0. That's the number of times in its entire history that the S&P 500 has lost money over any 20-year period. Let that sink in. Through wars, recessions, bubbles, and crashes, if you stayed invested for 20 years, you came out ahead. That really shows you the incredible power of just being patient and staying in the game. But, and I have to say this, it's incredibly important. We always have to add the big disclaimer. History is our guide, but it is not a crystal ball. That amazing track record is, well, it's in the past. There are absolutely no guarantees in investing, and you have to go into it knowing there are risks. So I'll just leave you with this question to chew on. Knowing that time is probably your greatest ally in all of this, how might that change the way you react to the scary headlines and the wild day-to-day swings of the market? It's a really powerful way to reframe your thinking. Thanks so much for tuning in.